Welcome to All About Your Company. Today we're going to dive into a very interesting story which is playing out in the Indian marketplace and has played out over the last 2 to 3 years, but now we're starting to see green shoots of a turnaround. And that starting FY26 itself. But Q1 FY27 also, Sheela Foam delivered a robust set of numbers. Let me first start off by setting the context up. What is Sheela Foam and what does it do? It's essentially India's largest polyurethane and foam manufacturing company, essentially. And it's the largest branded mattress manufacturer in India as well. It owns two of the largest brands within this space, which is Sleepwell as well as Kurlon. And it's closely owned. It's part of the Sheela Group. Market capitalization of around 7,400 crore as of now. But when you look at the chart, and if we could pull up the 5-year chart, before I go to the story, if we can quickly pull that up. Okay, we'll come to that in a minute. But essentially, what's the story? It's India's largest polyurethane foam company. It makes, obviously, the spongy material, which is inside mattresses, sofas, etc. It monetizes that as one of the core competence of the company in 3 ways. How does it do it? One, it does branded mattresses in India, which is in the form of the 2 brands that it runs. Then there's industrial or technical foam, which is used in various industries, including auto, for example, including the sofa industry in the furniture space, right? And then there's a third piece which it runs, which is the international business that it runs in Australia and Spain, which are also huge in terms of the value unlock that it has provided over the last year or so, at least. Maybe not the value unlock, but just the way in which the businesses have progressed over the last couple of years have been very, very strong. So those are the 3 verticals foundationally built on the business that they run. The foam is obviously the moat, and the brand is the premium on top of the moat that they run. And broadly on a standalone basis, 50% of the revenue comes from Sleepwell, which is their main brand. Now, just in terms of the 3 businesses, one, mattresses, it does around 50% of the standalone revenue from mattresses alone, and the brands are Sleepwell, Kurlon, and the like. Around the FY26 volume growth was approximately 12%. In fact, Kurlon did much stronger on volumes. And why is that fascinating? Because Kurlon is an acquired brand for Sheela Foam, and despite that, they did much better on Kurlon than on Sheela in terms of the volume growth that we saw. And it was the business which was going to take time in terms of integration, and therefore growth was going to be slightly slower, but it surprised on the upside where growth is concerned. The second one is technical foam, which is in front of you. This is approximately 46% of the standalone revenue. Foam sold to auto, furniture, packaging makers, and the like. FY26 volume was up 18% here, and volume continues to be robust here even now. In terms of the international business, Australia and Spain, here's where the real turnaround played out. There's Joyce Foam, which is Australia. It delivered a 10% EBITDA margin in FY26, and Spain also delivered a 10.5% EBITDA margin in FY26. Both turned around really sharply where FY26 is concerned. Okay, now let's talk a little bit about the Kurlon story, and this is where it starts to put the pieces of the story together. The logic was that they bought Kurlon in 2023 at around 2,035 crore. Sleepwell was strong in north and west, and Kurlon was strong in south and east, but the models were completely different, and therefore they bought Kurlon. But the concern was that the models were very, very different. In fact, margins collapsed, debt rose, and the stock has languished when you're looking at the 3 or the 5-year stock chart. The 2 brands completely different because the models were different. Now, what did they do thereafter? So they took a pause on growth, and they said that we'll clean up the business. They shut around 35 distribution centers. They cut company-owned stores by half from 50 to 24. They closed 6 plants. They optimized even within the plant. The raw material manufacturing process was optimized, and 10% saving even over there was achieved. And Kurlon was essentially a 3.5 to 4% margin product, and they've brought that and they've turned that around into a 10% margin product. Really, that is where the story resides, and that's where the value creation has happened at least over the last year and a half or so. The result now, of course, is that Kurlon has done a 14% growth and has done 10% margin. Debt has fallen sharply, and you'll see that story play out when we look at the financials as well. The raw material engine is, of course, there are two sets of raw materials, TDI and polyol. Both of them are crude linked, and therefore, as crude prices go up, you have concerns on raw material prices. The pass-through has to happen. Typically, on a falling price trend, you typically don't need to pass through too much because you have a branded product at the end, especially on the mattress side of things. But in a rising environment, it takes some time to pass things through. But despite that, they've held on to margins very, very well in Q1 FY26. So that's Q1 FY27, I beg your pardon. And that's the other part of the story. Now, in terms of the India mattress market, it has a size of around 15 to 16,000 crore. The real play is from unorganized to organized. They call this the U2O business, or the U2O strategy, which they are implementing. What they've done is 70% of India is still unorganized, and that is really the opportunity which all the competitors are looking to crack. Competitors like Duraflex, 60-year-old brand, and the newer ones, Wakefit, Sleepyhead, Sleepy Cat, Flow, and the like. Furniture players are also part of the competition. In fact, Sheela has a tie-up with Furlenco as well. And that too is now a high ROCE kind of a business. We'll understand all of this, of course. Plenty of nuances to unpack. Let's look at the financials now very quickly. 10% has been the 3-year growth, but remember, the last 3 years have been marred by plenty of choppiness, and therefore that's built into the numbers. But we are cautious, we're neutral on this count. You look at EBITDA, it's also gone up by around 10% on a 3-year CAGR, maybe a little choppy as well on the EBITDA number. You'll see that choppiness. Last off, with regard to PAT, it's in fact down 7%. Given the debt that's getting saddled, you're seeing that impact on profitability in front of you. So PAT is in fact 3-year CAGR is negative 7% on PAT. You look at the margin trajectory. Margins have actually improved from the low base of FY25. There's been a bit of a turnaround on the margin front, and you can see that in front of you. In fact, 10.6% now in Q1 FY27. You look at the Q1 FY27 numbers as well, 26% growth on the top line. Even though volume growth wasn't visible, it was mid-single digit kind of volume growth, but value growth has come through, and you'll see that translating on the margin number as well as the EBITDA growth that you can see, and profit has therefore surged off a low base, of course. Let's look at the balance sheet now, and the balance sheet again we're neutral on, and that's largely because while the book value is around 3252, which is it trades at around roughly 2 times book. You look at the debt is still approximately 700 crore. This has to keep coming off. This excludes lease liabilities, includes short-term debt, and that's the number we've put out. You look at the cash bank balance of around 36 crore lying in cash as well. So per se, it's an improving balance sheet, and of course, the 714 crore of debt coming off is going to be one piece that we'll look for. Cash flow has never been a concern per se. You'll see cash flow has been pretty healthy, clear thumbs up, no concerns at all. EBITDA conversion to cash. ROCE has fallen, especially in recent years, and understandably so. But the turnaround likely is at play, and we'll try and understand as to whether that plays out. We're neutral with regard to the return ratios, but you'll see that historically, FY22, FY23 return ratios were quite healthy, 14 to 18% odd. You look at the shareholding pattern now, 65% owned by the promoters, no concerns at all. It's a founder-driven company. FIs own 4%, they've trimmed their stake. DIs have also trimmed their stake. The public has in fact increased their stake in the business, and that's how it's played out. Very unique, right? You've got 2 buy calls, no holds, 1 sell. We're cautious with regard to this because just 3 analysts track this stock. 67% is the return potential, with 1 analyst having a very high upside, which is what is skewing the numbers. But we've put it out there for your benefit, that this is what analysts are penciling in. In terms of valuations now, this is where it starts getting interesting. Currently trades at around 35 times earnings, will shrink to 27. They've guided for a 15% top line growth and 15% EBITDA margin in the medium term, and therefore that 11 to 15%, that increase in EBITDA margin could play tailwind along with the top line growth being stronger than the last 3 years. Both of those could be big turnarounds, and we'll try and understand this story better. Let's bring on board Rahul Gautam. He's Chairman Managing Director, Sheela Foam, joining us. Great having you here, Rahul. let me start off by understanding first off with regard to how Q1 has panned out and try and dissect Q1 a little bit better. Volume growth hasn't come for you. It's value-driven growth. My understanding is that's what's played out. How much of the cost pass-through has happened because your gross margins have shrunk? Just give us some color on top line and gross margin.
Yeah, thank you, Harsh. Thank you for inviting me. So Q1 for us has been quite good. I know that there is some concern over the margins part, but let me just say that the top line has grown by 26% and the EBITDA margins are at 10.6%. And this is progress. We just have to keep in mind that we are coming out of the process of acquisition and then integration happening. And this is the third quarter in running when we have settled down and everything is improving. So we are very satisfied with whatever has happened.
And currently the top line is driven by value growth. You've guided for a 15% top line growth. Would you increase that just given the environment and given the fact that a large part of the growth is value? How should one look at volume versus value and the 15% target that you have?
So the target remains intact. Q1 may have been a little bit of aberrations here and there because of the raw material fluctuations that have been, or the volatility that has been there post the war starting in the Middle East. But we have held on well onto that, and we are on target for an EBITDA levels of 11 to 12%, and then eventually going on to 15%, and a top line also of 15% plus.
And the EBITDA margins, despite the gross margin trim, improved. I'm trying to understand whether it's international which has contributed, but it's a smaller part of your business, right, sir? So I'm trying to understand where is it that you're seeing margin expansion, or is it efficiencies? Is that margin expansion sustainable below the gross margin line items?
So you're quite right that the international businesses contribute a little part, that close to 20% or so of the business. The expansions have primarily happened in India, and they are completely sustainable. And the reason for that is that we are pulling out of the acquisition and the integration process. Some aberrations, I keep saying that, the volatility of this particular quarter, but otherwise things are settling down.
Generally, Mr. Gautam, Q1 is softer for you relatively to the rest of the year. Do you believe that Q2